It's great to see you both. Kim, I'm struck by the fact, before we kind of dive into inflation and all the rest of it, that in quite simple terms is the problem or opportunity right now that for the first time in years, there is an alternative to the U.S. stock market. Some of the yields you can get, forget even, in financial markets, in a savings, savings account these days are pretty good. We're talking about 4%. It's going to go even higher after today's Fed rate hike. So what is the net impact of all of that, do you think?
Sure. Well, I think the headline looks really great for interest rates, right? If you're somebody that wants to lend money somehow, if that's through a CD or if it's through buying a bond. So no doubt you're getting better rates. But here's the flip side of this. Inflation's really high. And if you're looking to grow your money, not just get return for some shorter period of time, bonds generally are not the way to do that. You have to be an owner of stocks to be able to get money over time. And that's just the way it works.
So in other words, yes, they're high in nominal terms, but they're still low in real terms. And who knows? I mean, but Subhadra, I guess if inflation's cresting, then maybe you pick up those yields while you can, and you don't have to worry about the stock market collapsing in the case of a recession.
Absolutely. And I think it's also a very good hedge, right? If you're looking towards potentially a meaningful slowdown in the economy or a recession, we could see some volatility in the equity market and risky assets heading into a recession. But bonds are going to be your safe bet. When you buy a 2-year note or even a treasury bill, you're locking in that interest rate for the period of time that you are long that bond. So to me, it feels like it's a good time to not just be focused on risky assets, which is what we've done over the last several decades, but also offset some of that with some real returns in the bond market. And if you look at the whole spectrum in the bond market, treasuries look attractive in the front end. But beyond that, corporate bonds and other, riskier bonds, where the default rates are still very low, look quite attractive to us.
Kim, what would you say about that? And where do you sit when you look at the investing landscape right now?
Sure. Well, once an equity analyst, always an equity analyst. So I'm going to, steal my own thunder there. But to be sure, you may want to move into bonds. But for goodness sake, stay on the short end of those bonds. Don't buy anything way out in time. Because, again, you have got to have these assets not just returning cash to you through dividends and yield, but you also have to have it grow. And again, if you're going to play the trading game, you might not come out on top because as rates fall, as rates rise, the prices fall. Mm-hmm. So do be aware of that if you're going to trade.
Subhadra, let's just talk about the landscape. What are markets telling us right now about the possibility of Fed errors being committed here when they're about to raise the benchmark overnight rate over 4% and basically nothing else in the curve, save on the very short end, is even yielding that?
They are focused on inflation, so raising rates is the right way to go to try to curb inflation. The question is where the end point is and what's a good time to look at perhaps going long bonds when the Fed is done. So for our view is that the Fed raises rates by 50 basis points today and then delivers at least another 75 basis points of rate hikes next year. So when they get to the terminal Fed funds rate, which might be as early as March or May of next year, they're going to keep rates steady for the remainder of next year until we really start entering into a recession. We have a recession penciled in for early 2024. So, for a good portion of next year, yields could remain relatively high in the front end. So I see an opportunity in the bond market under these circumstances. Yes, on an inflation-adjusted basis, right now it doesn't look so attractive. But as we progress through next year, inflation is going to gradually decline, and the returns on bonds are going to look even more attractive.